Today, the market is not moving on guesses or emotional reactions. Prices are responding to confirmed data and visible economic pressure points. Most people believe losses happen because markets are unpredictable. That belief is comfortable, but completely wrong. The truth is, most investors lose for very specific reasons. They react late, even when information is already public. They wait for certainty instead of preparing early. By the time confidence appears, the opportunity is already gone. This is not about intelligence or education level. It is about behavior under pressure. Two people can see the same chart and act differently. One waits for headlines while the other watches positioning. One follows emotions while the other follows structure. Same market conditions produce opposite outcomes. That is not luck. That is process. Most losses begin after clarity appears. That sounds backward, but history proves it repeatedly. People feel safe only after prices move. Safety in markets usually comes late. Late decisions are expensive decisions. Early decisions feel uncomfortable, but are usually rewarded. Markets reward preparation, not reaction. This cycle repeats every year without exception. The majority never learns because emotions feel logical. Fear disguises itself as caution. Greed disguises itself as confidence. Both destroy timing. The market does not punish ignorance. It punishes hesitation. It punishes emotional confirmation. It punishes chasing validation. Smart money does not predict headlines. It positions before consensus forms. That difference decides winners and losers. Today's market is showing this pattern again. Not loudly, not dramatically, but clearly. If you know where to look, this video is about recognizing that difference. Not to scare you, not to hype you, but to help you stop repeating the same mistakes. Because the market already taught this lesson before, and it is teaching it again right now. History shows markets repeat human behavior more than economic cycles. In 1994, interest rates rose faster than investors expected. Many traders waited for confirmation before acting. By the time confirmation arrived, prices had already adjusted. Those who prepared early protected capital. Those who waited reacted emotionally. The same pattern appeared during the dot-com period. Investors chased growth only after stocks doubled. Late confidence replaced early caution. Losses followed enthusiasm, not fear. In 2008, most people ignored warning signals. Credit stress was visible months before collapse. Markets were calm right before instability exploded. Calm phases are often misunderstood as safety. Safety usually ends when everyone agrees. Agreement removes opportunity. Disagreement creates it. Today, the market is again calm on the surface. Economic signals are not extreme yet. That is exactly why attention is low. Low attention creates mispricing. Mispricing creates opportunity. Opportunity appears before headlines. Headlines arrive after movement. Most traders confuse news with cause. News explains price after it moves. Price moves because positioning already changed. That is why watching behavior matters more than forecasts. Forecasts comfort people. Behavior exposes truth. The market is quietly repeating this lesson, not aggressively, but consistently. Those who recognize it early adapt. Those who ignore it repeat losses. This phase separates preparation from reaction, and the market never forgives repeated reactions. Many people think success starts with perfect timing. It usually starts with uncomfortable patience. One retail trader shared a lesson from Dow 20 volatility. He entered slowly while others waited for headlines. Prices moved before confidence appeared. He stayed calm during pullbacks. A decision protected his capital. Another trader shared a different outcome. He waited for full confirmation. By the time he entered, momentum was exhausted. Price reversed shortly after. The difference was not intelligence, it was positioning. Markets reward preparation, not certainty. Certainty arrives late. Preparation feels lonely. That loneliness creates edge. Keyword traders often miss this phase. They search for signals instead of behavior. Behavior shows intent before indicators. Another story comes from energy markets. In 2014, oil collapsed unexpectedly. Most investors ignored early demand weakness. A few noticed inventory pressure building quietly. They reduced exposure early. They avoided the drawdown entirely. Those who waited trusted consensus. Consensus failed. Consensus always feels safe. Safety disappears quickly. The same applies to technology cycles. Early adopters invest before comfort. Late adopters buy stories. Stories end faster than trends. Today's market shows similar patterns. Participation is selective, not broad. Money is rotating, not exiting. Rotation confuses retail investors. They assume exits. Professionals see redistribution. That distinction matters. Another success story came from bond markets. In 2022, yields rose steadily. One trader reduced duration quietly. Others dismissed the move as temporary. Temporary became structural. Losses followed denial. Adaptation followed observation. The market always leaves clues. Clues appear boring. Boring repels attention. Attention comes after movement. By then, opportunity is smaller. Keywords like confirmation mislead traders. Confirmation often marks maturity, not entry. Entry happens during uncertainty. Uncertainty is uncomfortable. Comfort is expensive. This phase rewards calm execution, not prediction, not excitement, just alignment. Markets rarely announce their next move loudly. They shift quietly while most people are distracted. Distraction is dangerous during transition phases. Transitions happen when confidence feels low. Low confidence keeps attention away. That is when positioning quietly changes. We saw this before during multiple market cycles. In early 2009, markets stabilized before optimism returned. Most investors were still afraid. Fear delayed participation. Those who acted early focused on balance sheets. They ignored headlines. They watched behavior instead. Behavior revealed stabilization before sentiment improved. The same pattern appeared in 2016. Markets absorbed bad news without falling. That was the signal. Today we see similar absorption. Negative headlines fail to push prices lower. That matters more than positive news. Markets reveal strength through resistance to weakness. This is often misunderstood. Retail traders wait for excitement. Professionals wait for stability. Stability allows controlled risk. Controlled risk supports longevity. Longevity builds real gains. This phase feels boring to most people. Boredom keeps crowd participation low. Low participation reduces volatility. Reduced volatility allows accumulation. Accumulation happens quietly. It never announces itself. Price movement follows accumulation later. This is why patience matters. Patience is not passive, it is strategic. Strategic patience separates survivors from gamblers. Gamblers need action. Professionals need alignment. Alignment is forming gradually, not fast, not slow, just steady. This is how markets prepare. Markets usually reward those who prepare before movement becomes obvious. Obvious moves attract crowds, not consistency. Consistency builds quietly during neutral phases. Neutral phases confuse most participants. Confusion reduces participation. Reduced participation allows smarter positioning. This is why volume matters more than headlines. Volume shows commitment. Headlines show reaction. Reaction is always late. Look back at 1995 market expansion. Growth started while sentiment stayed mixed. Jobs improved slowly. Rates were not immediately supportive. Yet markets climbed steadily. Those who waited for perfect conditions missed early gains. The same behavior appeared in 2012. Europe was unstable. News remained negative. Markets advanced quietly anyway. Stability mattered more than optimism. Today's market reflects similar signals. Bad news struggles to create downside. Good news does not trigger euphoria. That balance is important. It suggests internal adjustment. Adjustment prepares the next leg. This phase often frustrates short-term traders. They expect momentum. Momentum requires fuel. Fuel builds during patience. Patience is unpopular. Unpopular phases create opportunity. Opportunity does not feel comfortable. Comfort comes after price moves. That is why emotional discipline matters. Emotional discipline protects decision quality. Quality decisions compound over time. Compounding beats excitement. Excitement creates mistakes. Mistakes erase progress. This is why professionals slow down here. They observe reactions carefully. They track follow-through. Follow-through confirms intent. Intent leads price. Price follows behavior. Behavior is stabilizing, not accelerating, not collapsing, just stabilizing. That is how trends reset. Markets often test patience before rewarding discipline. This test feels slow and unproductive. Many traders leave during this phase. Leaving reduces competition. Reduced competition strengthens positioning. This is why smart money stays engaged. They do not rush decisions. They scale exposure carefully. Careful scaling limits downside risk. Risk management matters more than prediction. Prediction creates attachment. Attachment clouds judgment. Clear judgment requires distance. Distance allows observation. Observation reveals subtle shifts. Subtle shifts matter more than big moves. In 2018, markets stalled before volatility spiked. Those watching volatility structure adjusted early. Others reacted late. Late reactions increase losses. The lesson remains relevant. Markets whisper before they shout. Whispers are easy to ignore. Ignoring whispers costs opportunity. This phase is about listening. Listening means watching reactions. Reactions reveal strength or weakness. Currently, reactions show balance. Balance is constructive. Constructive phases support continuation. Continuation requires confirmation. Confirmation builds through time. Time filters weak positioning. Weak positioning exits quietly. Strong positioning remains. Remaining capital gains influence. Influence shapes direction. Direction forms gradually. Gradual formation avoids instability. Instability appears when moves are rushed. Rushed moves fail more often. This is why patience is rewarded, not immediately, but consistently. Consistency outperforms speed. Speed increases errors. Errors compound negatively. Discipline compounds positively. This phase builds discipline. Those who adapt survive. Those who rush struggle. Markets do not change human nature. They expose it. Markets often reward those who stay calm during uncertainty. Uncertainty creates hesitation among most participants. Hesitation limits aggressive positioning. Limited aggression reduces sharp downside moves. Reduced downside supports gradual confidence building. Confidence grows through consistency, not excitement. Consistency appears when reactions remain controlled. Controlled reactions signal internal stability. Stability allows capital to remain engaged. Engaged capital supports trend development. Trend development rarely looks impressive early. Early phases feel boring and repetitive. Boredom pushes impatient traders away. Impatient exits strengthen remaining positions. Remaining positions gain influence over price. Influence shapes the next directional move. Direction emerges slowly during balanced conditions. Balanced conditions filter emotional decisions. Emotional decisions usually create losses. Losses reinforce fear among late participants. Fear keeps attention low. Low attention supports quiet accumulation. Accumulation happens without public confirmation. Confirmation arrives after accumulation completes. This delay confuses most traders. Confusion leads to misinterpretation. Misinterpretation causes early exits. Early exits reduce competition further. Reduced competition improves risk-reward. Improved risk-reward attracts disciplined capital. Disciplined capital does not chase movement. It waits for alignment. Alignment develops through time. Time strengthens structure. Structure supports continuation. Continuation feels natural, not forced. Forced moves tend to fail quickly. Quick failures increase volatility. Volatility scares late participants. Fear creates opportunity for prepared traders. Prepared traders act without urgency. Urgency leads to mistakes. Mistakes compound losses. This phase rewards control over emotion. Control creates consistency. Consistency builds long-term success. Markets repeat this process regularly. Those who recognize it early adapt. Others repeat the same cycle. Markets ultimately reward those who respect process over prediction. Prediction creates pressure. Process creates clarity. Clarity improves decision-making. Good decisions reduce emotional mistakes. Emotional mistakes destroy consistency. Consistency is the real edge. Most people search for shortcuts. Shortcuts fail during uncertainty. Uncertainty exposes discipline gaps. Discipline gaps separate winners from learners. Learning requires reflection. Reflection improves future execution. This is why experience matters. Experience is built during calm phases. Calm phases feel uneventful. Uneventful periods build foundations. Foundations support future expansion. Expansion comes when participation increases. Participation increases after confidence returns. Confidence always follows price. Price never follows confidence. Understanding this changes behavior. Behavior determines outcomes. Outcomes reflect preparation. Preparation happens quietly. Quiet work beats loud opinions. Opinions change daily. Market behavior changes slowly. Slow change is more reliable. Reliability builds trust. Trust attracts capital. Capital flows shape markets. Markets respond to flow, not noise. Noise distracts weak positioning. Strong positioning ignores distraction. Ignoring distraction improves timing. Better timing improves risk control. Risk control protects longevity. Longevity creates opportunity. Opportunity compounds over time. Time is the true advantage. Those who respect time succeed. Those who rush repeat mistakes. Markets teach this lesson repeatedly. Few listen. Those who do benefit. This phase will pass. Another phase will follow. Preparation decides which side you stand on. Stay patient. Stay observant. Stay disciplined. The market always rewards clarity.